All right, folks. So we've got Richard Jackson here, who was on the show way back. Oh, when was it, Richard? You were on the Trading Nut podcast way back in episode.
Not sure. A couple of months ago.
It was
3 months ago.
I've got it in front of me here. Let me just find it. There we go. It was episode number 7. So we're currently at episode number 27. So that was 20 episodes ago. I can't believe it. But I'm so glad to get you back on here in video format. So we really sort of, the YouTube channel's taking off big time. And I wanted to get you back on to talk the guys through some of the stuff you probably mentioned in the podcast and just get more of a visual representation of what that looks like on a price chart. So do you want to first start off quickly and give us an update of what you've been up to in the last 20 episodes? It's probably 20 weeks.
Yeah, about that. Well, thank you for letting me come back on, and it's glad to see that you've been keeping busy as well. Yeah. But what we've been up to really formatting and putting like more education onto our website for new traders to come and work for us at Lepus Proprietary Trading and Jackson Capital. So we've been busy editing videos and all those sorts of things as well. Of really getting into detail on how traders can really get the knowledge to become a professional and start working for us.
Cool, brilliant. Well, look, today we're going to talk over what you think. Well, not what you think. Your version of convergence, and I think the traders out there listening and watching are going to be interested to see if it sort of lines up with their versions of convergence and what they sort of. I suppose how they pigeonhole it and understand it. And I'm interested to find out myself.
Well, I guess everybody has an idea of when they start trading, they have a look at a couple of books. Maybe they might learn Elliott Wave. They might learn some Fibonacci. They might learn an oscillator of some sort and get some sort of system that they've got going. Price action being, harmonic patterns like butterflies, Gartleys, bats and crabs, things like that. Having a look at different techniques. What I've really find, and I found this over the long term of teaching guys to trade, is that they really focus on one type of trading strategy at a time. And they give that a go, and if it doesn't work, then they flick over to a new type of strategy, and then they might, go to University of YouTube and have a look at that, and then they might read another book, and and then they start really just chasing their tail for the Holy Grail for a long time. And that's what happened to me, and I think that's what I said in my last podcast as well. I spent 5 years in my bedroom really trying to find out how to make the markets work for me. And, I was just going nowhere. So I ended up getting my own mentors from Chicago and New York and spent some time with them and really tried to understand, how to identify high probability trade setups. Now, most of the guys out there that are listening to this podcast right now probably already understand what divergence is. Okay, divergence is simply price action moving in one direction and the oscillator telling you a different story. Okay, so one price action and the oscillator being typically the RSI is diverging. It's like giving you separate signals. It's moving away from a single point. If you look up what the meaning of divergence actually is, it's moving away from a single point or an equilibrium state. Let's just quickly go to it. Divergence meaning. Okay. Divergence moving. Divergence between two, where am I? Okay, it's probably not there. I've just gone and shot myself in the foot. But what I want to do, what I really want to explain today is for guys out there, there is something else called convergence. You might have heard of it. It's sometimes called confluence as well, okay, where you get a number of support and resistance levels all meeting at the same place. But what I've done is I've taken that one step further. And this is what I teach the guys who come and trade with me, specifically this. How do we get high probability trade setup? Okay. What we do is we really look for support and resistance levels and Fibonacci and or Elliott wave really telling us the same story. Okay. because really, if you think about it, what is it that moves price? People. Okay, people move price. Okay, it's not, well, we can say it's volume, but it's still a person behind it. We can say algos move price, but algos are still written by a person, isn't it? Okay. So if a person moves a price, they're obviously looking at something, or they're anticipating something to happen at a certain point, right? And they might be using moving averages as their support and resistance levels. And you can see on my screen here, certain moving averages have very high probability as support and resistance levels in the market, okay? Added to that, if we use Fibonacci as well, and we know from Dow theory, the Fibonacci, the most common point on a Fibonacci level is the 50%. Okay, 50% to 618. Most of the time you'll get a reaction. Okay, so if we look for a confluence area between the two, so let's say that this here is my leg of my trend. Okay, I'm looking at that leg in there. And then I go and pull my Fibonacci on the same leg. What have I got down in here? In that area there.
Yeah.
Okay. What I've got is confluence or convergence of this 50 to 618 area plus the 200 period moving average. Okay. So if I'm a Fibonacci trader and Cam, you're a moving average trader, right? Then both of us are looking at the same thing. So therefore, there's now a high probability that we will get a reaction at that point. Does that make sense?
Yeah. Okay. So basically, the more of these things you put together, I suppose, the more likely some other people are putting the same things together, or maybe just one of them, and looking at it going, this is a chance for the market to turn, because we're all thinking, hey, look, it's at the 200 moving average. This is a sign that it's going to turn, or it's gone below the 50 and it's just touched the 618. Yeah, I see what you mean. Yeah.
But look out! We've got these tops over here, and if I extend those tops along, we've got more of an area, don't we? Right. So typically, what we would do is we would go out to our daily, okay, and we would look for common areas of support and resistance. Now we're really going sideways quite a lot over here on the euro. So let's go back in time a little bit where it's a little bit more obvious for us. Okay. Okay, so let's have a look at what's going on here on this chart. Okay. In here, this is a classic example of what we can look at for confluence areas. Okay. So let's count our Elliott wave. We've got 1. We've got 2, 3, 4, 5. Okay, 5 legs of Elliott. Do you agree?
Yep.
Okay. Then we've got a break of this trend line that's coming through here. Does that make sense?
Yep, that makes sense. Yeah.
Okay. Then what we've got this low in here that's around about this $1.13 mark. Okay. $1.13 has been a very key level on the on Elliott wave. On the euro recently. Okay. We've been bouncing between $1.13 and $1.15 for a very long time. Okay. So if I take a Fibonacci now from that level to that level, I've got this area down in here, right, of the moving average, of the 618 area plus the break of this trend line, okay, to come back and pick up on the trend line. Does that make sense?
Yep. Yeah.
Okay. So this is typically how, a lot of us, this is typically how we trade, okay? Here's another example over here. Let's have a look. We've got to move down in through here. Okay, we've had a look underneath the $1.13 level, but we've broken through this trend line. Okay, so a trend line break is typically something that people look for. Plus, we've got a retracement back into the 50 and the 618. Does that make sense?
Yeah.
This is where we trade. Okay,
yeah.
We would have a limit order sitting in there waiting for us, because there's two types of trading. First one is antagonistic. And that's what we're doing here. We're antagonizing the market because we're going to be in there before everybody else, okay? Because we're expecting a reaction there. Second is evidence-based. A lot of people do evidence-based, but with evidence-based, and evidence-based is good for when you're doing, when you're trading the news. But if we wait for an evidence, like this pop of this candle in here, let me just zoom in a little bit for you. The pop of this candle in here, right?
Yeah.
Our opportunity to take our stop from here to here, right? Let's say that we get in at the end of this candle, we've still got a one is like our risk to reward is still really bad. Okay.
Yeah.
Okay. But if we're antagonistic, and we get in down here, our risk to reward is 7 pip, which means that our risk to reward is really good now, right? Does that make sense?
Yeah, that makes sense. Yeah.
Okay, so that's what I mean by confluence or convergence trading. Okay.
It's funny because somebody just sent me, and I mentioned in one of my, or the podcast going live next week, which could be any time from when people start seeing this. Somebody was asking about, like, ask the traders if they use limit orders or if they use market orders. And so how often do you use market orders versus limit orders?
Swing trading, with my swings trading strategy, which I detail in the course, it's always a limit order. Okay.
Right. Yeah.
Because the thing is to be honest, the average trader out there, unless you're a professional day trader, that you've got to do things during the day. You're not going to sit there glued to what's going on all the time. Now, with our news strategy, it is a market order, but we know exactly when the news is going to come out. So we're there anticipating. We're already there waiting for it.
Yeah.
Okay.
Yeah.
So limit orders, because a lot of my traders also have full-time jobs, right? So they trade and do this at the same time. So what they'll do is they'll get up in the morning, they'll have a look. If there's something that they can see, then they'll put a limit order in there at the right spot. And then they'll come back and just check on it on their phone every hour, right? Until either the stop or the target has been hit.
Yeah. Yep. Cool. Brilliant. Well, look, I'll tell you what, I've learned something here in just this short period of time. It's interesting. I've never seen, in all the interviews I've done, I've never seen this approach where you bring these things all together in such a succinct way so that there's no real, I suppose, confusion over what's going on. And also, even just using the Fibonacci 50 and 61.8, it just makes it so much clearer versus...
You can see here by, the results down here that we've got small losses and large wins, right? And this is the whole point of trading, okay?
And you know what questions I'm going to get asked is like, why are you showing me a demo account and not a real account? And so
the reason why I'm showing you a demo account is because what I do is all of my traders trade on a demo account, right? And what I do is I show them, I keep them on the demo account and I keep them at around about the $10,000 mark. And what I do is I copy that onto my 5 mil account.
Yeah.
Because if I give my trader the 5 mil account, going from a $10,000 account to a $5 million account, they will freak out, right? Yeah. What I'm trying to do with my traders is keep them, the two things which will make a really good trader is consistency and good risk management. It's not about profit. It's not about any of that stuff, about being consistent. But if I take them from a $10,000 account or a $100,000 demo account into a $5 million fund, right, they'll freak out psychologically and they'll destroy themselves. Okay, and that's the reason why I only deal with demo accounts.
Yeah, and that makes perfect sense. And that hopefully answers the question for anyone who's going to leave a comment here on the in the video on YouTube, which I know they like to do that. So I'm glad you answered that for us.
Yeah,
perfect.
But if anybody wants to learn how I put it together, okay, divergence, all the support and resistance, moving averages, Fibonacci, Fibonacci expansion, all of these things together, right? Then they need to come and have a look at the course.
Cool. Brilliant. Or look, there's going to be some links underneath this video, guys, so go and click on those. Go and check them out. You can probably get access to Richard's podcast interview that we did. It went for maybe 45 minutes. It got your full backstory and a whole bunch of other stuff, insights into trading. So people go and check that out. And what else have we got for them, Richard? There's a few other things we've got there.
Well, hopefully we'll do another podcast soon.
Yep.
As well, and we'll have the course if they want to learn how to do the course on their own. If they do want to, if you're keen and you want to become a trader of mine, go to lepusproprietarytrading.com.au and check us out because we bring on traders all the time to trade FX or just derivatives, CFDs on commodities, FX, and indices.
Brilliant. Yeah, that's right. So the new thing is the course. So Richard's put a course together which should be absolutely superb in terms of trying to master some of the stuff that he's just talked about today. Well, look, short but sweet. Thank you for coming back on the show in video format this time, and we'll get you in audio format again in the future and get you on the show.
Okay, no worries.